expenditure method is the second method of calculating GDP. The previous one was the value added method, where we saw how each firm was contributing to output, to production, and we added that. Now, if there are some places where that cannot be ascertained, then maybe you can ascertain the expenditure. All right, because any income that is earned, so let's say the value added that is made by a firm is his income. Okay, now that will be spent. Okay, so that will be spent on something. So what are people spending on? You can use that data to also find out the GDP, because if you're making an expense, means you earned that money from somewhere, right? So factor incomes which are earned by the factors of production can be spent in the form of expenditure on goods and services. So that expenditure is equal to income. So you can calculate the expenditure made on goods and services. So what you have to do in this method of calculating national income, you see the sum total of the final expenditure, which is made by the four sectors of the economy, which is households, business, firms, government, and foreigners. Okay. Now again, it measures national income as the sum of expenditures made by households, business, government, and foreigners. Okay. In the previous method, the summation of gross value added was equal to GDP at MP, right? If you added the gross value added, it was GDP at MP. From that, you had to subtract depreciation and you had to subtract net indirect taxes to arrive at NDP at FC, which was domestic income. Similarly, in the expenditure method, when you add the expenditure which is made by these different sectors, which are households, firms, government, and the export sector or the foreign sector, that also, the sum of all these expenses is also, it adds up to GDP at MP. So again, to get to NDP at FC, you will have to subtract depreciation, you'll have to subtract net indirect taxes. Okay, so they both add up to gross domestic product at market cost. This is also called the income disposal method. Okay, so GDP is C plus I plus G plus X minus M. There's also this term called statistical discrepancy. So if you are given in the question that there is some statistical discrepancy, you add that. That becomes part of GDP. Okay, because data collection has its errors. All right, so there are different components to final expenditure. The first component, when you add final expenditure, the first component is called private final consumption expenditure, which is basically, in other words, consumption expense of households. So when households spend, that expenditure, the name of that expense is called private final consumption expenditure. So let's look at the name again. Private, so that is households, final consumption expenditure. So consumption is technically called private final consumption expenditure. That becomes the first term, that is the expenditure of households. Okay. The second is the expenditure of the government. So instead of government, what do we write? Government final consumption expenditure. Government final consumption expenditure. That's the second component. The third component is investment, which is basically done by firms. Okay, investment. Investment is technically called gross. So that means it does not subtract depreciation. Domestic, we know what domestic means. Capital formation. Capital formation means addition to capital. So this means gross domestic capital formation. So that is nothing but the investment of firms. That's the third component, gross domestic capital formation. And the fourth is exports, which is made to foreigners. So net exports. So the expenditure by households, by firms, in households, government expenditure, firms, and foreigners. That's the four entities which make expenses. Okay, so we will add these. Yes, we will add these, and it comes to, what does it come to? It comes to when we add private final consumption expenditure plus government final consumption expenditure plus gross domestic capital formation plus net exports. When we add these, we get GDP at MP, right? So we add all of these, and what we get is GDP at MP. All right. So these are the four components of final expenditure. The final expenditure could be expenditure made by households, firms, government, or foreigners. Is this clear? Okay. So we'll come to each component. So there are some things that we need to know in this, because questions are not so easy, right? So we need to know each component properly. Private final consumption expenditure, the first component. Expenditure which is incurred by households and non-profit institutions serving households, okay, on all type of consumer goods. Okay, so let's read this line again. It is expenditure which is incurred by households and private non-profit institutions which serve households on all type of consumer goods. What is included in consumer goods? Let's see that. What is included in consumer goods is durable goods like washing machine, not a house. Semi-durable goods, non-durable goods and services. Okay. So non-durable goods like food, टिकता नहीं है. Durable means जो टिक जाता है. Non-durable जो टिकता नहीं है, बिल्कुल ही नहीं टिकता. Like खाना. Today you get it. Today you make it. It has to be consumed. Semi-durable, it can stay for a few days. Durable, it can stay for a long period of time. So these are the kind of goods you can spend on, but house is not a consumption expenditure. House is an investment. So that is why a house is not included in private final consumption expenditure. A house is included in investment. So we'll come to that. So all type of goods which are bought by consumers are included here except houses, and all type of services also. Government spending. So this is part of government final consumption expenditure. Okay, so this is again consumption expenditure and not investment. So this is part of consumption expenditure and not investment. Resources which are purchased by the government are unavailable for consumption or investment. Government purchase of goods and services includes, what does government purchase of goods and services include? Let's see that. Government purchases of goods and services include things such as defense. Government spends on defense, that's included. Roads built by state and local government, salaries of government employees. All of that is included in government consumption expenditure. Okay, so one more thing to take care of this, take care here, is that government makes certain transfer payments. Means let's say ISI gives scholarship to people. ISI doesn't charge any money, no, it gives scholarship to all the students because it basically pays you money. It doesn't really charge any money from you. So when ISI pays you money and doesn't charge any money from you, that's called a government transfer payment. Transfer payment is something that when you're making a payment to someone without them giving you something in return. So the students of ISI don't really give anything in return. They don't even promise कि हम कुछ करेंगे देश के लिए. They don't promise कि हम पढ़ाई अच्छे से करेंगे. They promise nothing. Okay, but still they get that money from the government. That's called a transfer payment when nothing is given back in return. Okay, so social security benefits, unemployment benefits. Transfer payments is not included in GDP since it is not part of work done. Okay, so that's the only thing that we need to take care of when we think of government expenses. Okay, so all government expenses for consumption purposes is included, which includes all government expenses, but not transfer payments. All right. Now the next term was investment. Investment is called gross domestic capital formation. Okay, gross, you know the meaning of gross domestic capital formation. Now why such a long word? It represents addition to capital stock for the economy. It represents expenditure on acquiring goods for investment which are located within the domestic territory. So this gross domestic capital formation has two components, which is what is going to come in the exams. Gross domestic capital formation किससे बनता है? The first is gross fixed capital formation, and the other is again change in stock. Okay, so the first component of gross domestic capital formation is gross domestic fixed capital formation. This word fixed is extra. So it could be gross fixed capital formation, or it could be gross domestic fixed capital formation. So when you're only talking about the fixed part is like land, house. So when you're only talking about fixed part, then it is gross fixed capital formation. Okay, whether the word domestic is there or not. Okay, so gross fixed capital formation is the first part of gross domestic capital formation. It refers to the expenditure which is made on purchase of fixed assets. Fixed assets can be any plant, machinery, equipment, which is called business investment. Houses, which is basically called residential construction, which is purchase of new houses or construction of new houses. And made by the government, which is construction of roads, bridges, flyovers. So roads, I think I mistakenly mentioned in the previous case in government expenditure, but since it's an investment, it should come in the investment component. It should not come in the consumption expenditure part. So any sort of investment, whether made by households or firms or government, is included in this, not included in the consumption expenditure bit. So sometimes roads are included in both the things, some text because of Pakka road and Kacha road and those considerations. So Pakka roads don't break, so they're included in investment. Kacha roads break every time, so they're not really included in investment, which is why sometimes roads come in both. So that's the reason. But in general, the concept that you need to understand is this, that any investment is included in this component, and the consumption expenditures of households and government sector is included in the private final consumption expenditure and government final consumption. Okay, so that was the gross domestic capital formation. And gross domestic capital formation, as I said, has two components. It has the gross domestic fixed capital formation, and then it has change in stock. Okay, so change in stock, something we've already done. It refers to the physical change in stock of all the raw material, finished goods and semi-finished goods, which is lying at producers. Okay, so it is an investment, as I said, that when you have goods which are unsold, that becomes your, what do you call it, unanticipated investment or unwanted investment. These are all the equations just again written. All right, again to reiterate, any purchase of shares and debentures, whether old or new, is not included in investment. For example, if I've purchased 500 shares of Reliance Industries, it may be investment for me, but it is not an investment for the whole economy. So shares and purchase of sale and debentures don't even come in investment, because it is not an investment for the whole economy. It is an investment for me. All right, so this is something that again shows it properly. The gross domestic capital formation is fixed capital formation and change in stock. Okay, so these are the two things. Fixed capital formation will be business investment, residential and public, and change in stock is closing stock minus opening stock. All right, government spending I've already included. And the last term is net exports. You already know this. It is the difference between export minus import. That is net exports. Exports refers to the expenditure by foreigners on purchase of domestic goods, and imports are the expenditure made by residents on foreign goods. Okay, they are part of net exports. So this is the whole setup. You can just go through this of the expenditure method. So these are certain examples which I thought of questions that we'll do, but I mean, I'll just do it in short. So C plus G plus I plus X minus M plus statistical discrepancy will sum up to GDP. Okay, so you can check that. This is another example of question. So we can also check that private consumption expenditure of durable, non-durable services, gross private domestic investment of non-residential, residential and change in business inventories, government expenditure, whether federal or state, net exports, both only imports are to be subtracted, all of them added together will give GDP. Okay, so you can check that also. Precautions, again, the last thing, second-hand goods not to be included, shares and bonds not to be included, Transfer payments not to be included, intermediate goods not to be included.